All right, let's get right into it. We're about to break down a single trade, a really, really fast one, that pulled in a $1,500 profit. And the goal here isn't just to gawk at the numbers, it's to actually understand the strategy behind it. How do you take a moment of pure market chaos and turn it into a calculated win? Now, look at this. The key detail here isn't the profit, it's the time frame. 3 minutes. We're not talking about buying a stock at 9:30 a.m. and praying it goes up by the end of the day. This is all about what traders call velocity of capital. It means you get in, you catch a massive burst of momentum, and then you get right out. You're trying to be exposed to risk for the absolute shortest amount of time possible. So you got to ask the question, right? Was this just a lucky shot in the dark, someone who happened to be in the right place at exactly the right time, or was there a repeatable, disciplined system making it all happen? Well, that's what we're here to figure out.
Okay, everything, and I mean everything, starts with the catalyst. If you want to trade the news, you first have to understand what kind of news actually moves a stock like this, and what's just, noise.
And this slide right here shows the difference perfectly. So over on the left, you've got a gapper. This is a stock where some news dropped overnight or before the market opened. By the time you and I can actually trade it, guess what? The big moves pretty much already happened. But on the right, that's the good stuff. That's true breaking news. This is a stock that's just sitting there, totally quiet, doing absolutely nothing. And then bam, news hits midday and injects this insane instant shot of volatility. That's the setup we're looking for. And for the stock in our case study, NBEV, the catalyst was, get this, a tweet. Seriously. News came out that Kendall Jenner's diet included some of New Age Beverages brands. It's not some big earnings report or a huge FDA approval. It's just hype. But look at what it did. The stock went from a dead quiet $1.87 to $1.96, just like that. The fuse was officially lit. So the news is out, the stock is taken off like a rocket. Now comes the hard part. How do you actually get in a trade that's moving this fast without just blindly chasing it to the moon? Let's break down the execution. This is what I call solving the chicken or egg problem. Do you buy the absolute second you see the headline? No way. That's a gambler's move. The process has to be disciplined. So, first, the news hits. Second, and this is the most important part, you wait. You let the market show you its hand. Third, you verify. You're looking for that huge surge in volume and a clear upward direction. And only then, after all that, do you look for your spot to enter on the very first tiny dip.
And here's what that looks like on a crazy short time frame, a 10-second chart. You see that first pop up to 196. The trader waits, lets it breathe for just a second, and then gets in between $1.97 and 99. And boom, right away, a hard stop loss goes in at 189. The risk is defined before anything else happens. And as the stock starts to prove it's the real deal, the trader even adds a little more to the position at 206.
Now the trade is on and you're just riding the wave. You're glued to what's called the time and sales tape, and you're just seeing thousands of shares getting bought up every single second. It's a blur. In just a few moments, nearly 2 million shares trade and the price just squeezes up 28%. This is what pure raw momentum feels like. I mean, it feels amazing, right? The trade is just printing money. Profits are climbing by the second. But when things are moving this fast, there's always a hidden danger. One giant risk that can turn a huge winner into an absolute disaster in the blink of an eye.
And here it is, the circuit breaker halt. It's also known as the limit up, limit down rule. Basically, if a stock moves way too fast, the exchange can literally slam on the brakes and halt all trading. As NBEV screamed up toward that halt level at 234, the risk of getting frozen in the trade got higher and higher. And if it halts while you're in, your money is stuck. You can't get out, and you have absolutely no idea where the stock will reopen. It's a trader's nightmare.
And that brings us to, honestly, the most important part of any trade, the exit. Knowing when to cash in your chips and walk away, that's what separates the pros from the gamblers.
The philosophy here is a classic one. You'll never go broke taking a profit. So the second the stock showed its first little sign of slowing down, the traders sold a piece of the position at 213. That one move instantly guarantees it's a winning trade, no matter what happens next. Then, as it pushed up again but started to struggle near that halt level, the rest was sold at 228. You prioritize getting paid over trying to squeeze out that last final penny.
And this slide. This is why that disciplined exit was so brilliant. Just look what happened after the trader got out. The hype died down just as fast as it started, and the stock gave back the entire move. It retraced 100%.
The lesson here is crystal clear. Don't fall in love with the stock. Anyone who held on hoping for a home run just watched all of their profits completely evaporate.
Okay, so let's zoom out from this one trade. How do we take this single event and turn it into a repeatable blueprint, a system that actually works over time? Well, it all comes down to a simple set of rules and some basic math.
It really just boils down to a few rules that you can never, ever break. First, you have to trust the chart, not the headline. Let the price action and the volume be your guide, not the emotion of the story. Second, you always, and I mean always, protect your capital with a stop loss. That's non-negotiable. And a third key rule is knowing the stock's float, how many shares are available to trade, which tells you how explosive it might be.
And here's the math that makes this whole thing sustainable. In this trade, the risk was about $700 to make $1,500. That's better than a 2-to-1 risk-to-reward ratio. Now, what that really means is you only have to be right about 33% of the time just to break even. A strategy like this doesn't demand perfection. It just demands that your winners are bigger than your losers.
So here it is, the whole thing boiled down into a simple 5-step plan. Step 1. Monitor for that quiet stock that suddenly gets hit with news and a massive volume spike. 2. Verify the price action on a small time frame, but don't you dare chase it. 3. Enter on that first little pullback. 4. Protect your position immediately with a hard stop. And 5. Exit into the momentum or at the very first sign of weakness.
And that right there really says it all, doesn't it? Success in this game isn't about trying to catch every single stock that moves. It's about having a plan, waiting with incredible patience for your setup, and then executing that plan perfectly with total discipline. That's how you build an edge that lasts.